welcome to the Capital Discussion Market Analysis. I'm Tom Nunemaker with Jim Riggio. Before we get started, have our standard disclaimer. Capital Discussion is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, profit or loss may vary due to market factors such as liquidity, slippage, and commissions. Okay, that's a mouthful. I should memorize it.
I thought you did.
No, I've got I cheat. I have a piece of paper to print out, so. Let's do what Charles Connell did and record it and speed it up so everybody doesn't have to listen to it so slowly.
Yeah, I do that sometimes, by the way, with my iPad.
Mm-hmm.
If I'm driving, if I know I'll have a drive, for example, and I don't have an audio book, I'll actually open up one of my books, or I'll download a PDF and I'll have it read it to me. Except for I don't have it read it at normal speed. I have it read it at New York speed. Okay.
That's a nice feature on YouTube. You can speed things up by up to 2 times, I think it is. Okay, so how are we doing on the market? See, I gave you the ball, Jim.
Okay, let me let me come and get the ball here.
I noticed the Vix Futures are awfully flat going out.
Yeah, I know. It really was really an interesting market today. I had a lot of things going on. I didn't get a chance to end up watching throughout the entire day, but I do have them on my screen, and I'm always peeking. Here was one of the things that I ended up taking a look at. And I've shared this with you guys before, right? I end up looking at the daily charts, and I like to end up taking a look at even the 1-minute stuff about where markets have moved and what's driven, okay, the market. This morning it was pretty scary, okay? And if you guys haven't seen this, what I'll do is let me highlight. What I end up doing is I'll always take a look at what the VIX is doing or the VXX is doing compared to what the futures are doing, okay? And as we were running up on the VXX and as we were running down on the market, the volume was spiking pretty high. And if you take a look at, and I'll just make it a little bit bigger, the down bars had a lot of volume. It got to be pretty ugly. Then we got to the 10 o'clock reversal. If there's certain times that you need to end up really taking a look at. The first half-hour trading, a lot of times there are, orders, and, there's a lot of retail stuff that comes in or overnight orders. Usually by 10 o'clock, if there's going to be a reversal within the day, it usually happens 10:30. It's a very key area that I'd end up always taking a look at. And let me just line these up so that they're the same. And we did. We got a reversal. Okay, I will tell you this specific bar at 10:03. Look at the blue volume. Look at the movement up. It was the first bar that we ended up having that, and I keep moving, and I don't know why it's moving on me. I got to tell you, Thinkorswim is just sometimes drives me a little bit crazy. The quality of that product after Tom Sosnoff left is amazing. Anyway, so you see the volume move up, and that really did kind of mark a low for at least the morning session. We started to end up moving forward. It really was quite a reversal. Okay, I don't know if you guys saw, but if I end up going back in the morning, okay, overnight we were up huge. Okay, we had gotten up to 2048. We open up at 2042, and we just tank. We just absolutely tank throughout the day. And basically, more or less, we ended up running pretty much sideways. It was very, very encouraging that when we ended up having the sell-off, okay, late in the day, right, we started to run up around 2:30 late in the day. We ended up finding some buyers, but what I wasn't too thrilled about, okay, is that when we were selling off here, there wasn't a lot of volume selling off, but when we were bouncing up, there wasn't a lot of volume going up. A little bit of volume to end up trying to run it up, but they ran it right back down. But then this was the most encouraging thing that you saw all day. As they tried to sell off, continue selling it into the close, what ended up happening on the close? There was a lot of volume to end up holding it so that it didn't sell off anymore. So I'd say that, the end of day was a very, very positive thing. You can see what ended up happening here in the last few minutes in terms of the VXX. The VXX did not end up continuing to end up tanking. It did end up moving up. So we got a little bit of a conflicting message there. Okay, so those were the things that I ended up seeing when I was looking at the stuff throughout the day. The other thing that we had talked about, and this was some time ago, was what happened with the whole influence of oil. Let me come over here and take a look at some charts and just show you some stuff on oil. We broke again. Let me get rid of all these other studies. Sorry about that. Okay. And this was just a note that I don't need this here. Let me get rid of this. Right. This is what we ended up talking about, right? This doji, okay? That looked great for a while. It held, but let me get rid of all my drawings here so that they don't come in your way here. Remove all drawings. Okay. We had sold off, okay, as we opened up the new year. The first 3 sessions were horrible. Looked like we were starting to hold again, and we got down to, we broke 46. Hit a low of 45.62 today. Now, one of the things that we ended up talking about was that oil prices can end up absolutely hurting some of the larger institutions, especially financial institutions, where there's anything that would be oil-related collateral. Think about things like oil trusts, Canadian oil trusts, things like that, where basically what the trust is that you're buying the future stream of payments that they're going to get for selling the oil once they pump it out of the ground. And you buy it at a discount, right, because you don't know what's going to happen to oil prices. I can tell you that while you've bought it at a discount, okay, and they tend to end up doing very well over time, you didn't buy it at a 55 or 60% discount, and that's how much oil is down from its peak. So with this level of a pullback, some of those trusts or any times oil-related products have been used as collateral could end up causing some financial stress in different areas. And we had seen that happen, right, in terms of taking a look at, for example, does it affect the larger market? The way I would end up taking a look at this, I take a look and saying, well, does it affect the high yield? Well, it did affect the high yield at one point, but then it kind of eased off. With oil dropping at this point, there's only so much more damage you could end up doing. At some point, we take a look at oil, and it is because of a couple of things. Obviously, it's a proxy on the world economy, because the world needs oil. For the more economic activity we have, the more oil we end up using. But it's also a supply question at this point. You take a look at the shale oil projects, or you take a look at the Dakotas, okay, and the fact that the U.S. is producing more oil than at any point during the last, I read the study, I think it was like 23 years. The problem with this is that when you think about things like fracking, the amount of oil, okay, or the life of a well, of an initial well versus a fracking well. The fracking well costs a huge amount of money to be able to end up doing, and its lifespan is only a fraction of a longer term of an original well. So what ends up happening is that there's this oversupply, and there will be this oversupply for some time, but it's not a long-term permanent type solution. So you take a look at what could end up happening with oil. And I think that that's what we're seeing and why you have things like HYG not getting continually hurt by the pricing in oil. The other thing that we ended up talking about was that how does this affect the bigger picture in terms of U.S. dollar versus the other currencies? You know, we had talked a lot about, and I know it's Tom's favorite subject. It's always interesting paying your mortgage in one currency and getting paid in another.
Yeah, that's sometimes good, sometimes bad, but you can
Sometimes
see
good, sometimes bad. You know, Tom, I don't envy you. For many, many years, okay, for 4.5 years, I used to have to end up balancing getting paid in U.S. dollars and having all of my expenses come in Swiss francs. And some months it was great, and some months it wasn't. And you try to end up planning, and it's you know, it would almost be a joke sometimes. We continue to end up selling off in the euro. We have had 2 days where the you know, the heavy pressure subsided a little bit. And Tom, let me get this so that I can just go into basics so you can see that on numbers.
Yeah, we dipped below the 117 handle again today.
Yep. I mean, here, let me take this back just so that you have a bigger picture. If I go back 20 years and do the monthly chart so we can actually see. I mean,
Looks like
this is
low as 2005 time frame.
right here. Okay. So this is the lowest point since exactly late 2005, early 2006. You know, a lot of people think that it may end up being a support level. You know, we ended up having, and from here going back, right? I left Europe in 2001, and the euro was just being introduced, and it was introduced below parity. Right? It was introduced at, I forgot what the number was. Tom, do you remember? It was like 80. It was in between 85 and 90 cents.
Yeah, I was actually in San Antonio when they did that. So we, like I said, we left everything that was in Deutschmark and came back, and it was all the same numbers, only with euros. So it suddenly got it.
But for those that you don't know what the conversion was, okay, from euro, I mean, that means he got really screwed, by the way. Tom had to pay a lot. Everything was a lot more expensive. You know, the other thing, it's a lot of it, too, is being driven by the yen. Okay, I always want you to end up knowing. Okay. Yen is also at a multi-year high. Okay. Now, remember, this is compared to the U.S., and it's not like we are the, you know, the panacea for a low-debt, well-run government. Okay.
Yeah, my analogy is the race to the bottom. Who's the least worst today?
Right. You know, if you want to end up seeing how things are really, really horrible, compare them to the Swiss franc. Okay. Because the Swiss franc, very, very different. Okay. USD CHF. Okay. Where, you know, this was the peak when I was living there. I was getting 1 franc 80 to the dollar. Take away this one little blip, and we got down to 80 cents. It got cut more than in half. More than in half. Now what's happening is that the U.S. economy is getting a little bit stronger. Fear, by the way, always helps the U.S. dollar. It helps the Swiss francs, but it also helps the dollar. And so when I take a look at what's going on, one of the things that all of this, some of the analysis that we ended up talking about was that this would end up hurting, a strong dollar would end up hurting international-based companies much more than U.S. only. So when you end up taking a look at what ended up happening with this, what we started to take a look at, and let me do a comparison here. Let me go to the RUTs. And what I wanted to end up showing, okay, let me get rid of my studies. Oh, you know what? Let me just do it this way. This would be easier to do it this way. Let's go and just do the basic chart.
Hey, Jim, Jerry First just joined us. Jerry's actually speaking at the roundtable this week, but he's an expert in technical analysis as well, so it'd be interesting to see what Jerry's comments are.
Jerry, how's it going, sir? Let me just
Jim.
delete these and get everything into a daily chart, because I wanted to be able to end up showing what was going on with the dollar versus, with the SPX versus the RUT. So let me end up doing a study here. And after I get this one up, Jerry, I'll put up any one that you want to end up seeing. Okay.
All right, and just good to do a quick audio test, getting ready for Thursday, if you can hear me okay.
Yeah, you're loud and clear.
Excellent.
Okay, let's take a look and see maybe over the last 3 months.
While you're pulling that up, John Dory asked, the futures were up pre-market. Any idea what accounted for the shift? I know we had an economic report in the morning. Was it December retail sales? Was that the catalyst?
Oh, for the sale this morning. I was on the phone with the guys up in New York. Okay, well, the market was opened, and they really didn't see anything. One guy ended up saying, "Well, was it because of the bounce just a feel-good thing on Monday about what happened in Paris in terms of their unity, right? Their unity march and everything else, and what weren't really sure." So I didn't have any answers for you. This is what we ended up seeing, okay, when we had the sell-off in with oil. We had seen the RUT outperform the SPX. The other way around. You can see the SPX over here, but we really haven't had any help, okay, with the dollar, with the RUT. Everything has been a bit volatile. Jerry, what have you been seeing going on with the technicals across the markets, okay, and driving particular sectors?
Very interesting question there, Jim. As far as obviously oil is the main driver. So are you buying the dollar? Are you selling the euro, as you started alluding to, on a global higher level? And then when you start looking at the indexes individually, are you going to look at it? It always comes down to the individual investor and or institution, or in your case, management. Are you investing in trading with Dow components or Russell 1, 2, or 3,000 components? Because there's always rotation. And so then when you talk about sectors, it just seems to me like I'd like to say it's just normal rearranging the decks, rearranging the chairs in the beginning of the year. But at the same time, sometimes I think that we're whistling past the graveyard, so to speak, because we've just been on such an artificial sugar high for so long. You wonder when the insulin's going to run out. How's that?
Well, the insulin has, right, we start with our insulin shots, right, meaning that QE ended. Okay, so when I take a look about the sugar high in terms of not only the Federal Reserve but central banks around the world putting money and flooding the markets with liquidity by buying their own treasuries or their own sovereign bonds. What ends up happening is that the U.S. is at least a year, in my opinion, in front of the rest of the world, in the sense that we started our QE earlier. We've been tailoring a plan to end up ending. We've recently ended, whereas Japan is going full bore, and Europe is doing everything that they can given their rules and regulations in their multi-country experiment that they're running with the euro. Is that what happens if we start to see things like Greece fail? One of the things that we ended up hearing in terms of that had driven the markets down last week, the week before, was what happens if Greece fails? What would happen if Greece gets taken out of the euro? Now, there was a lot of talk about, it would be even more expensive for the Germans and for some of the other stronger countries to be able to end up handling that. But what all of this does is that it adds fear, uncertainty, and doubt into the market. And so we are going to end up getting much bigger swings. One of the things, Jerry, and we had developed this, I was a part of it, but Dave Thomas was the guy who ended up writing most of this, was that we ended up writing and saying, most of the time what ends up happening when the market ends up going down, we tend to end up seeing the daily ATRs get bigger. The market doesn't just all of a sudden go down, okay? The ATRs, the daily ranges, tend to end up getting bigger. And so what, after a lot of talk and discussion, what Dave actually wrote all the code for was, we took a look and saw underneath a very short window, what was the probability that, let's say, the last 3 days show that the standard deviations are getting larger or smaller compared to the previous window. You need to use at least an order of magnitude larger. So for example, what this ends up saying is that when you look at the last 3 days and compare that in a student T, normal distribution type of deal, for the 30 days before that, what's the probability that things are getting better or worse? Now, what this ends up always showing us, we tend to end up getting very large spikes, okay, when the market starts to sell off. Now, it doesn't come down as quickly as you would like, right? So it's a great indicator showing you that things are starting to get ugly. Like if you take a look at this part, they're starting to get ugly before they go down, but it never gives you a point to the bottom, right? So it's a good indicator when the market going down, not so much. We had seen this. Now, this was interesting. We did not get our indicators early, well, very early over here. And the bottom one, by the way, I'm looking at 9 and 90. I'm looking at 3 and 30. You can look at any time frames. There's a whole bunch you can end up doing. Tom, I think we've posted this someplace. The shorter time frames get quicker reaction, okay, to show you, but you also get a lot more false signals. And we're starting to rise again. The volatilities, it's more, acceptable for us to see, 20-point moves in the rut, 30-point moves in the SPX, okay, or, in the ES futures between the morning and the low points a couple hours later. For most of last year, those types of moves, they just didn't happen. And so we started to end up moving, a lot more. The other thing that I end up taking a look at, and I haven't updated this, I think I have the latest one here. I wanted to end up just showing you the future spreads. Okay. What we're looking at, and let me just get rid of this one for a second here, because this one always, let me just not show that study. Okay, what we're looking at here is a graph of the Vix Futures. Some of you, I know, we've talked about Vix Central and other places. This is actually a 15-minute graph of the spreads. So, for example, the green line, sorry about that, the green line is the 2-month minus the 1-month future on the VIX. Now, normally when we are in a normal contango environment, in a perfectly smooth normal contango environment, the 1-month versus the 2-month spread would end up being lower than the 3-month versus 2, or the next one after that, and that's the yellow one, right? So it's the 2-month minus the 1-month. The yellow is the 3 months minus the 2 months, and the red is the 4-month minus the 3 months. But we are actually in backwardation. Okay, we're below zero. on these things. And, I take a look at the level of movement that we've ended up having. Now, we've gotten more into line. The graph on the top, okay, what we were looking at, by the way, was that we were looking at the VXX, so that we were looking at the volatility on the VIX options versus the volatility on the S&P options, right? Because the VIX is basically telling us what the volatility on the SPX or the S&P 500 is, okay? And it's measured by the implied volatility of the options. And the VIX is just an indicator of what that is. Looking at the next derivative, right, looking at the volatility on the VIX options was the blue line. We had gotten ourselves way out of whack where the volatility on the options had moved much, much higher. I had shared with you guys before that there was a December 15th Goldman Sachs report that showed that the VXX, since its introduction in 2004, had 2 of the 10 highest days in December. Now, I don't know about you, since 2004, that includes all of, the financial crisis, it includes the debt ceiling, the financial cliff, it includes all of that. I didn't think that December felt like it should have been, in the top 20%, right, 2 of the top 10 days ever since it was introduced. The same thing, we had 2 of the top 10 days in terms of how far the VIX moved in a week. So when you take a look at the 1-week move in the VIX, okay, in the fourth quarter, once in October, once in December, we had 2 of the 10 largest days since it was introduced. And by the way, it was introduced back in 1990. So that also includes, the whole .com fiasco. So the volatility of movement and the fear seems to end up being much, much greater than what we've actually moved. And when that ends up happening, that ends up telling me that institutions are more afraid than retail guys, and that's a time to be scared. Every sell-off that we've had last year never seemed to last more than about a week or week and a half. So when we finally do break, I think it can get very, very ugly. But I don't know when that break is. I think that we need to end up having a catalyst. I don't think it happens, without a severe catalyst. It needs to be something like, Greece defaults, its banks go down, or something like that. The market, for example, could end up, if the market ever lost confidence in any of the central banks, like the Bank of Japan, for example, you realize that the Bank of Japan, before they started doing quantitative easing, had a greater debt to GDP ratio than Greece. But Japan rates aren't that low. Aren't that high like Greek rates. So there's just a lot of moving parts in this market, and if the economy picks up, Greece gets better, Japan rates stay low, their stock market starts to get better because of how, and think about this, they're trying to drive down the yen so that their exports can be more competitive. Okay? If that ends up happening, and it can end up all blowing over. There's no question about it. That's probably the case.
If I could chime in on one of your points about a minute back, as far as I think what you're talking about is what are the major dominoes or contagions that could take place. So if you look back at 2007, 2008, the first real domino to fall was when Bear Stearns folded. And it took about another 6 months. Bear Stearns folded February, March. It took September, October, before it started to ripple through to Lehman. And that's when all of the margin calls and all of the promises started getting torn up. And then it becomes a crisis in confidence. And that's when the buck got broken. And so now the problem is that every time that we've inflated these bubbles, whether you go back to the savings and loan crisis, the dot-com bubble, the real estate bubble, the bubble keeps getting bigger every time. And now we're dealing with trillions to the point where it becomes truly an awesome number to try to wrap your brain around. So, so the contagion effects now with oil could be, the contagion effects start. You start to go ahead and start to slowly see margin calls come in. As you see, typically in volatile markets, you're going to see that first 30 minutes is when people are being forced out of their positions, getting liquidated within that first half hour. And then you'll really know when we're in the volatility when the last half hour of the day becomes really crazy. The scary thing for me is that, Jim, you've been around a long time, Tom. 700-point days on the Dow have happened in the past, back when we were at one half of where we are now. So a 1,500-point day, look, we had a flash crash with 1,000 points in a minute. We had Apple losing 7% of its value about a month ago in 1 minute. And so those are the kinds of things that it almost, as option traders, I assume that the majority of the people here are option traders. Those black swan out on the wing events, it seems to me as if you just got those calls and puts way, way out on the edges with lots of time, and maybe you've just got some limits to get triggered, that's one strategy that what I believe the major institutions now employ. Goldman, J.P. Morgan, they all have lots of bets that are on the outliers. So anyway, the contagion, could it be in effect? And also, it looked like we started to go over the edge about a week or two ago. And I could go ahead and, Thursday show you some of these charts where the market and the charts want to complete certain patterns. And then it looks as if the market wants to, the plunge protection team or whatever the case may be, wants to go ahead and say, no, we're not going down. And whether it's right or wrong, it keeps the pension plan solvent for another day. To go off on a wild tangent, I don't know if anybody watches the television show Person of Interest, but the last 2 episodes have focused around stock market crash. And within a matter of seconds, they actually blurted out a couple of moments of truth about how they have to protect the market at all costs. So if you have a chance to go back and look at the last 2 episodes of that, it's an interesting show, and they do touch on the market. They're actually literally having shootouts in the New York Stock Exchange. But so anyway, sorry to interrupt there, but I'm sorry, Jim. Go ahead.
No, I was pretty much, done. I did want to end up saying, that we're going, I don't see anything being solved. So while we're doing this shootout, in your words, or while the Bulls and the Bears continue to end fighting, we're going to continue to end up getting, I think, some very large intraday moves, and they're going to be more the norm. I think that one of the things that's happened over the last almost 2 years, with the market being as strong as it has been, is that there's been a level of complacency that's happened, where people just they're not afraid of the market pullbacks because, well, the market just keeps bouncing right back up. Okay, look, the central banks of the world flood the markets with liquidity, plunge protection team, or whatever you want to call. That the markets are, I guess it started with the, we originally started calling it the Greenspan put, and I guess it's just been, the torch has been handed down now twice, but I take a look, and it wouldn't surprise me. it wouldn't surprise me if we ended up having just massive volatility, like 2008 type of volatility. Will it end up all being down? Will we end up having the sell-off? Well, it depends on how bad some of the things that we've talked about got or will get. Until you have resolution and until you have confidence back in the market, you're going to end up seeing these levels of volatility. I think that when you take a look at the the 5-year chart or even longer, let's just go to a basic one here for a second. I'll show you this last one, and then want to start to end up wrapping things up. Since remember what happened here, right? This was the whole debt ceiling, okay, issue, the downgrade of the U.S. debt. We were worried that the U.S. wasn't going to be able to pay its bills, and there was a lot of it was the initial sell-off. But look at the level of volatility we had. Look at, if I come in here, look at how big your bars are, okay, in terms of your daily range in this area versus what we've had here. Here we've have this nice cyclical move. Yes, we did have this pullback. Okay, yes, we did have a little one here, but the October one was big and the December one was relatively big. And I take a look at those pullbacks. They were just, I mean, they're amazingly, everything is V-shaped. Everything is V-shaped, okay, for the last, 3 years. We go back, and when did we have a pullback for longer than a month? Maybe this was 2 months. Okay, you had a couple of months here. But the volatility, okay, when you have this level of a sell-off and these levels of rebounds, what ends up happening is it just makes it emboldens the bulls. And when they get taken down, I think that there's a chance that they get taken down very hard.
Hey, Jim, I only see one question from Andrew. He says, Vix Futures seem to have had a big reaction to an average move in SPX today. Any comments on that?
Andrew, this is going exactly back to what I said and what we ended up reviewing with the Goldman paper from a couple of weeks ago, right, from December 15th. When I take a look at what's happened, maybe not here. Take a look if I have a better chart. You know what? I don't. So let me just pull up the VIX itself. Go to a basic chart. And let me take a look at this. Right. Look at the level of moves that we've had. This was the December move. By the way, we hadn't broken, if I end up going back on this, okay, if you take a look going all the way back, this was the whole financial debt ceiling issue. Once we ended up coming down on that, look at the series of lows. So it got to a point where, every time it would have hit, maybe 21, 22 for the better part of a year, huge opportunity to sell vol. We've broken that. So I think what's happened is that when you see the move here, and Andrew, this is exactly the point that you should be looking at, right? You're asking the right question. The moves on the VIX have outstripped the moves in the market. So I look at 3 different things, okay, when you look at this, Andrew. Look at the relative move of the VIX, of the SPX versus the VIX, and look at the relative move of the VIX versus the VVIX. And what ends up happening is that when the derivative, right, when the VIX is moving more than the SPX, when the VVX is moving more than the VIX, that ends up telling you that bigger, larger institutional money is scared. And they are getting insurance in place. Now, I will end up saying, with the advent of, VXX, UVXY, VIXI, and all of the VIX-based products, that does have some influence on it. So was that what happens is it makes it much, much easier for retail guys to go out and hedge using a leveraged VIX-based product. I had recently spoken to, at the end of last year, actually it was originally over the summer, somebody who owned UVXY as a hedge. Now, if you've done this, don't feel bad, because I actually know a $1 billion RIA that was trying to hedge buying VIX trying to buy VXX. So if $1 billion RIA does this, don't feel bad if you've ever done this. They try to end up buying VIX as a hedge, and VIX, and how do they end up buying it? The easiest way to end up buying it for most people is the most liquid product is VXX. Now the problem is, if I just take a look at this last year, yeah, these are really big spikes. But look at what happens every time it settles. Now, do I think that the VXX, when it moves up, it can move up like a scolded cat? Sorry about the animal lovers, but it can. It moved from 26 to 44 in a matter of a month, right? So it can move massively. And by the way, this wasn't even a big move compared to some of the other things, because we did remain in contango through most of this. But when you see the levels of the pure levels of volatility end up moving on the VIX and the VVIX, and they start to outpace what you would end up expecting, usually, historically, that tells us that we should be afraid of market pullbacks. And for I would say for two things. One, for just the straight long investors, it's not a terrible time to either take some off the table or start to end up hedging with any of your favorite negative delta trades. Yeah, you might end up losing on them, but I just think that at this point in the market, yes, we can rip up. There's no question about it that's a possibility. But when you take a look at the level that the S&P has run up over the last few years, and say, how much more room can we continue on this path upward, or do we have any type of a recovery? I'm just worried. I want, and the things as Jerry ended up pointing out, right? I think that it's the oil, it's the currency, it's happening overseas. Okay. Those last time, 2008, no question about it. The world had every right to be pissed off at the U.S. because we caused that. Okay, in terms of our mortgage, our over leveraging. But at this point, we've worked, and while our spending of our government has continued, while we've really kind of masked that with our quantitative easing, for the most part. At least we are getting. We're not contributing to the fire the way the Japanese are, the way certain parts of the EU are, and unfortunately, when you overspend and don't collect enough taxes, like so many of the governments around the world have done for decades. There needs to be a price to pay at some point. Of course, no politician would ever tell you that, because then they wouldn't get elected. But I don't need to be elected. I just need to be able to manage people's money.
I think that's it for the questions. So thanks, Jim and Jerry, for the interesting analysis of what's going on.
Jerry, could you just give us, just a quick, preview of what are you going to be talking about in the roundtable on Thursday?
Okay, great. I don't know if I can go ahead, and it'd be a nice thing if I can go ahead and test sharing my screen for a second. All right, so let's see. What do you guys see right this second?
Well, Tom has to give you the ball, and then you just end up accepting and sharing your desktop. But while you're doing that, why don't you tell us what you're going to be going over?
I'm going to go over technical analysis for options. And so the concept is that when we're option traders, we can go ahead and just go on a hunch because earnings is coming out, and we can put on trades that way. We can go ahead, and some people like going on the bell curve, and/or we can do charting and technical analysis, where we're looking for the basics of support and resistance, and you can buy and/or sell the support and resistance levels based on other assumptions. When you add into that fundamentals, it's just adding the probabilities into your favor.
Now, when you say fundamentals, you're not talking about company fundamentals. You're talking about market fundamentals, right?
It could be both. It could be both. I mean, as an individual investor, I mean, look, there's great opportunities to go ahead and pick up some really inexpensive options ahead of earnings that are based on fundamentals that the charts also go ahead and point in the right direction. As far as only working within indexes, there's obviously a time for that, but I think that I always like to say, it's both. You want to have your cake. You want to have your cake and eat it too. Yeah, of course. It's so basically talking about charting, showing a lot of different charting packages that I use. I've been a student with some of the best educators in the world, John Bollinger, Steve Neeson with candlesticks, as well as Steve Bigelow. As far as I've just been, from the very first time back in Jim and I share, we both worked at IBM years ago, not at the same place, but I was on Prodigy back in the mid-'80s when the internet first came up, and that was when I saw my very first stock charts. And I just knew as I was looking at these different stocks that there had to be a pattern in there. And of course, what did I settle in on? The very first pattern I settled in on was the dead cat bounce. I was looking for those stocks that got thrown out of bed, but they had to go ahead and come back up. Little did I know that there were people like Kerr and McGee that had written books on technical analysis going way back into the 1930s. Now with computers and everything else, the power that we have to go ahead and look at the charts, and with YouTube and everything else, the ability to go ahead and understand these patterns can put the odds in our favor, but it also creates another dimension where the more people that understand these things, the more they can be manipulated by institutions. For example, Investors Business Daily, they love the cup and handle pattern. And I think that for the most part, for the average person who doesn't have too much time to focus on this, William O'Neill came up with a decent strategy. But because the institutions know that a cup and handle pattern is going to suck in a whole bunch of retail investors, and by the way, to put in a 7% stock loss, well, I found it very interesting that Apple had a 7% drop in 1 minute, triggering tons of retail investors who had their 7% stop loss, And so charting, technical analysis, we'll be going over chart patterns, some of my favorite techniques. I've been using Option View since 2004. That gives me 10 years in there. I used to be the Option View user group coordinator down here and in South Florida. So it should be interesting. I hope everybody tunes in. I don't know if you can.
To it.
If you're on Windows, if you do Control-Alt-D, that will share your desktop.
Control-Alt-D. Okay.
And while we're just wrapping up, I also wanted to just thank you. Paul Demers put a post in there that I thought was really, people should end up realizing. Goldman made an analysis where shale investments, shale oil exploration investments would be curbed at $40 a a barrel. One of the things, and Paul, I don't know if it was in here, I know we had spoken about it, the Saudis would love nothing more than that. So they aren't lifting a finger to slowing up the drop of oil right now. They don't want to cut production. They'd like to be able to have it go down, get all of that shale riffraff guys out of the market. So this way they would be happy when oil goes back up to 120.
Right.
I'm sorry, but I was just filling while you were pulling up your desktop there, Jerry.
You can see it now.
Jerry, so
Yeah.
you're good to go.
Okay, excellent. So here, for example, this is a weekly chart on oil, and we've got patterns inside of patterns. So you can see a triangle pattern inside of a triangle pattern, so that gives me more confidence. It doesn't tell me for sure that something's going to happen, but it's all about putting the odds in your favor. And of course, notice this very, very strong support line right here. Once we broke that, you know, we had, notice how it sliced right through this supporting, it came and it bounced. This is a weekly chart, obviously, that if we go ahead and drop back down to a daily chart, this is one of the charts that I'll go ahead and share with you. These charts are actually free, and you'll get free real-time futures quotes with these with this software program provided by one of the old Forex brokers back when I used to trade currencies a lot.
Hey, Jerry, we're looking at PowerPoint, right?
Oh, are you looking at PowerPoint?
Yes.
Yeah, golden.
Yeah, we don't see your mouse moving.
That's great. Okay, hold on a second. And here I well, then you were staring at the death cross. Okay, this is what I thought I was pushing right here. That's why I like to test these things. So, for example, take a look at this. You were showing this chart before, and in fact, back in the summer of 2011, when we had that whole debate about the sequester, that was one of the best trading times that I had. I love the volatility. And you can see this back in Sunday, November 9th, I posted, it's actually the last time I posted on the website. I went ahead and I made this assumption that I'll be watching for possible triple top to form on the S&P 500 with max resistance at either the 2064 or 2093 range within the next 3 months, and between November and February to be followed by, I'm expecting, and a lot of people are expecting, that we're long overdue for that 20 to 30% plus correction. And of course, that's just my opinion. I could be wrong. But I also noticed, Jim, what we were talking about earlier, you know, between the ECB injecting €1 trillion, the Japan bonds, insurance issues coming up, there's a lot of stuff coming into 2015 where we have opportunities. As long as we have these squiggly lines, those represent opportunities, whether it's the S&P or if it's Apple or United Healthcare. So notice my numbers, 2064 to 2093 range. If I go back over to the S&P chart that I had done that analysis.
High?
I'm sorry?
Wasn't 2093 the high? Yep, there it is.
There you go. There it is. And what's the date on that? Let me go ahead and pull up the crosshair. So what week was that? That was back December 28th, December 21st. Notice I put that in November 9th. That was back over here. And again, candlestick patterns. Here's something that you can see better versus the screenshot of my blog post. Notice these hammer candlestick patterns right here. Let me go ahead and notice this is a picture perfect. Not only is this a perfect hammer, but on candlestick patterns, notice the huge move, this huge red bar down with the exhaustion point, and then followed by a large positive bar back up. And notice that that happened again over here for the most part, almost identical. Notice notice the hammer here. Notice not a hammer, but you've got the wicks banging out the bottoms here. And yeah, Jim, as you pointed out, we have not had a sustained pullback really since the fall of 2011. Everything has been just a very, very quick pullback. And what happened back in the summer of 2011, that was the beginning of QE2. So what a lot of people don't know is that the U.S. Federal Reserve was pumping lifelines, umbilical cords to the other central banks around the world. And now that we've kind of like said, okay, we're not buying our bonds anymore, we're expecting the other central banks to pull their weight, you can see some of that taking place. But Japan is trying to go ahead and step in. But Europe is not a tight cohesion. And it's interesting, if you go back in history, they tried this European Union idea back in the late 1890s, and it didn't work out too good. So,
for my experience in the military with NATO, that explains it, because like trying to get a regulation change in the Air Force is hard enough, but when you have a bunch of different countries that each have to sign off on anything, it can take years to make one change in a regulation. So I can see how an economic union of multiple countries with different cultures and objectives and everything would be a nightmare.
Who've also had wars for the last 2 millenniums.
Well, yeah, you throw that in there too.
Yeah. Now, Tom, you're in Germany, right?
Correct.
So you tell me, with your, ear to the ground, as far as, from what I understand, Germany's kind of tired of, pulling all the weight, and...
The Germans are okay with Greece leaving the EU as long as the German taxpayers aren't stuck with the bill.
Exactly. And yet France doesn't want that to happen as long as they don't have to play by the rules.
Right.
So the political and the cultural differences in the EU, and I made some joke about this experiment, okay, that I called the Euro. Tom, and I know that you've been there as part of the military. I was part of their expatriate committee, if you will. Okay, I had done work across multiple countries, and I keep telling you, I had no idea about the political and the cultural deep-set bias across the continent. It was just amazing to me. In the U.S., I really don't care, what God you pray to, where your parents were born, what your sexual orientation is. I care, hey, if we're doing business, are you going to end up being a good business partner? There, they really do have many, many biases, and so many of them are culturally based. And to see the Northern Europeans and their approach towards things, say, versus the Southern Europeans, it was truly astounding. So when I take a look at what Europe ends up having as problems, they're absolutely, huge. But I wanted to kind of interrupt, Jerry, because we've been going for about an hour. You're going to end up going all day on, the whole session on the roundtable on Thursday. And I just wanted to end up letting everybody know this one thing. Jerry's views. Most of you out there, I know, are premium sellers, a lot of options, and love to end up selling credit spreads. Jerry's going to bring a very different point of view. Jerry, most of the big losses that you've ever taken in your life because the markets, you've been selling these, 10 deltas or 20 deltas, and the markets ripped through you, Jerry's usually been sitting on the other side of that trade. Okay. Jerry looks for times when, because remember what I always tell you, I always say that what you're doing is that you're selling an implied volatility. And if the market actually moves more than the market was implying when you sold it, you're going to end up, losing. If the market moves less, you're going to. So what Jerry looks is, he's looking for key spots where the potential of the market running significantly in one direction or another outweighs what he actually ends up having to pay for that spread or that options trade. And what I really like what he's does, and he's going to end up showing you how he does this, is that he combines the technical piece and the options piece to find the greatest reward with the least amount of risk. So unlike most of us that would be happy to end up selling, a 10 delta if we could get X amount of money for it in a spread, Jerry looks at things a little bit different, and it would be a discredit to yourself if you miss his talk on Thursday.
Yeah, I'm looking
Jerry,
forward to it.
All right. Well, very good. Thank you, Jim. Couldn't have said it almost better than myself.
We appreciate you stopping by a little bit early, and we really look forward to seeing you on Thursday. For those of you that are in the covered call class, we had our first session today. Next session's on Wednesday, and we're going to actually be talking about some of the technical stuff, but not for another week and a half or so when we end up doing the class. Thank you, everyone, for coming tonight.
Thanks, everyone.
Okay, thank you, Jim. Thank you, Tom.
All right. Bye-bye.